Good morning. Welcome to the morning market briefing. Today is Thursday, August 20th, 2026. Hope you're doing well. Today is Tomorrow Day, so that's always good for Tom and I. We generally like that. We also have Walmart earnings today, John Deere earnings, but one of the things that we really want to get into is a discussion on Scott Bessent's involvement in both Iran, and he's doing some really interesting things at the Treasury, which we want to talk about as well. Just getting you the headlines on Walmart and John Deere, because those are big bellwethers in the economy. Walmart was a little bit worse than I had anticipated. The traffic decelerated from the first quarter, and Sam's Club was about where you thought it might be. On the margin side, I think this was probably another negative, is that all of the margin, that the headline showed a massive beat, but all of that was due to IEEPA tariff refunds. If you actually strip that out, they implied that operating margin was actually down because they're investing more into price, and they actually expect that to be more negative as we go into the back half of the year. So they're investing in price, and we're seeing that in the general merchandise sales. General merchandise went from mid-single digits to low single digits. The inflation in general merchandise went from 4.4%, and I had to make sure I double-check this. This is like-for-like inflation went from 4.4% to 1.7% in general merch.
Below the Fed's target, by the way.
Indeed.
Notably.
Grocery had a little bit of a tick up in inflation, but that was just to 1.3%. They're really getting hit on the health and wellness side of things, where they're also seeing massive deflation due to the maximum fair price implemented on January 1st. That hit them by 900 basis points, meaning that they actually comped negative on the health and wellness on the pharmacy side. But the big takeaway for me is that inflation's coming down at Walmart, and that they're still investing more into price. This is the same thing that we heard from Target yesterday. Target was able to drive a little bit more traffic, so they had a good result. But Walmart down about 5 or 6% pre-market. They've been executing exceptionally well. I don't disagree with this move to invest in price, because I think that is their value proposition. But the market doesn't like that.
Yeah, but I think that it helps them sustain where they're going, given that we're seeing the trade up. We're seeing a lot of people start to move. We talked about it yesterday, from TJ Maxx back to, higher end stores. Well, Walmart's probably the first one to get axed. And as a result, they start cutting prices that continues to keep them competitive.
You have to maintain your leadership position. Yeah. And then John Deere continues to deal with a really bad ag cycle. They reiterated their view that 2026 is the bottom in the ag cycle. But it continues to be very soft. They did have a bit of an improvement on the construction side, which isn't really a surprise given what Caterpillar had said as well. So I'm not terribly surprised by that. But big ag, they're dealing with what I call the 3 Fs: financing costs, fuel costs, and fertilizer costs. On top of that, they have ag prices that have been actually relatively low because we've had exceptional crops for the last 2 years. So big ag is just, they don't have the money to spend on new equipment, and they don't have the money to, importantly, service that equipment. A lot of the tractors that they're producing now are really difficult to maintain, and you got to get a Deere specialist out there who will charge money, and a lot of people just don't want to deal with that. Right now, they're just kind of sticking with their old equipment or buying used equipment because they know how to work it. So that's what John Deere is dealing with. Their stock's up about 2% pre-market, but we'll see how that trades as the day goes on.
It's interesting because they don't seem to have any of the AI overlap that Caterpillar does.
No.
Which is interesting because you think like these guys are competing head-to-head, but there's a lot of nuance there, particularly as the AI infrastructure thing starts to play out. So maybe a little bit of a an opportunity as it continues to fall behind. If you see the AI trade flip, you want to be in something that's more of a pure play combine maker as opposed to a construction/combine/AI infrastructure play.
Right. Yeah, I definitely think that that's probably the case. I would like it a little bit cheaper than it is today, but I think that Deere, over the next 10 years, should do fairly well. I think they continue to lead in agriculture. And at some point, we all know with the iPhone, you might like your old iPhone, but at some point it can't run anymore.
Yeah, the battery starts to die.
And so you have to get the new iPhone, just as a lot of these farmers will have to get the new tractors. All right, let's talk about the story of the day. And it was really the story of yesterday, unfortunately came out after the call. And that is related to Scotty B. He is taking very much a leadership role in the administration. I would even say that he's probably obviously he's probably not more important than Trump, but if there's a 1A, I actually think that's Bessent now. And I don't even think it's a number 2. I think he's pulling a lot of strings, and I think he's even pulling strings with Iran now. A week ago, he said that Bessent said that the U.S. is going to apply measures never before seen on Iran, for example. And yesterday evening, Trump said, "No one has given the Islamic Republic of Iran a greater opportunity to make a deal than me. They failed to take it. Therefore, today I am announcing the most crushing economic operation ever taken against any country. This will be economic warfare and isolation on an unprecedented scale." This is an economic D-Day. And so basically in Trump language, saying what Bessent said last week.
Yep.
So that we have that news, and then they had this big announcement that I'll let you talk through here in a second, Tom, yesterday about really significantly increasing the amount of buybacks that they're going to be making of long bonds at the U.S. Treasury.
Yeah, so it's an interesting, I would say, be very careful of how you digest what the financial news media is saying has happened versus what has actually happened. So in effect, yesterday, the Treasury announced that they're going to increase the buybacks on long bonds by at least double. So their current maximum size is about $2 billion per operation, and they're increasing that to $4 billion, and they're targeting bonds in the 10 to 30-year range. It starts effective September 9th. Shout out to my wife. That is her birthday. And it will, in fact, basically through the beginning of November. But the idea is they're basically doing a Treasury version of Operation Twist, which is that they're basically doing a cash out refi of bonds that have been previously issued. So the great example of this, I believe it was CVS back in 2019 when the Fed raised rates. CVS prior to that had issued a very large short-term bond issue, and say they raised $15 billion. Well, you do that when rates are at zero, then the Fed raises interest rates. Suddenly those bonds that you got $100 for because you lent that money are now trading at $90 because they've raised interest rates on that tenor and your bonds have now priced down. Well, now I've got $10 billion in cash sitting in the bank that I just got from this, and I borrowed $10 billion, but now those total assets are worth $9 billion. Well, I can just buy those back and I can net $1 billion. And that's essentially, in layman's terms, what's happening with the Fed right now. Is they issued bonds at lower levels. We've now seen the long end blow out. Well, what they're doing is they're buying back those bonds for less than what they got for them, which is in effect almost the opposite of QE. So if you listen to the financial news media, they'll be like, "Oh man, this is QE. The Treasury is just doing it instead of the Fed." It's actually the opposite, because the Fed would print money and buy bonds. What they're doing is taking money that they've already borrowed and buying bonds that were backed by those dollars that are now worth less. It's like I sell Ben a car for $10,000, and then he offers to sell it back to me at $9,000 a month later. That's great for me because he already gave me $10,000, and I'm just giving him $9,000 back, and I have the car and $1,000. So I mean that's what's really happening here, and it's very nuanced. And people are failing to understand what's happening here. And they're painting it as monetary intervention, Fed flavored, but it's actually monetary intervention, Treasury flavored, which is totally different.
And I think you bring up a great point, because this is not printed money.
Correct. And it's money that already exists.
Unlike QE, it is not printed money. You're exactly right. And I think that we went from $2 billion per operation, and Bessent said at least $4 billion. So that's not. They went from a maximum of $2 billion, which means they could do anything up to $2 billion, to a minimum of 4.
Greater than or equal to.
Yeah. So at a minimum, we're doubling the size of this operation. And people aren't reporting that effectively. And then people aren't reporting effectively something that we just talked about, and that is the knock-on effects of this. And basically, there's a whole host of intricate bond math ramifications. But the big takeaway that people need to understand is, as rates come down, fund managers who have a certain target, and they call it a duration target, and basically essentially an average maturity target for their portfolio, as rates come down, they're going to actually have to buy longer and longer bonds, which is essentially doing the Treasury's work for them. So the more that the Treasury can get that long rate down, the more that Fidelity, BlackRock, any of these big fund managers are going to have to buy those long bonds, insurance companies. And so I think you can really create this feedback loop going the other direction than what we've experienced. And I think that, and I know Secretary Bessent gets that, because this is what he's done for his entire career, is understanding how to lean into these feedback loops so that you can make a very profitable trade, just like when he broke the Bank of England.
Yeah, so if you think of like the world's largest mutual funds are actually not equity funds, they're bond funds. Things like PIMCO Total Return Fund, DoubleLine, Vanguard Total Bond Fund. These things are the worst version of investing in bonds, because by prospectus, they have to be, single A or above. Is single A always the best credit to buy? Probably not. In fact, I would say it's almost always the worst, because it's not too hot, it's not too cold. They almost always have to have a duration between 6 and 7. They have to have so much exposure to government bonds, so much exposure to corporate bonds, et cetera. So they're bound by their prospectus to what they have to buy. So what happens is, if you have a bunch of bonds that have a structure where there's a call in the middle, if rates extend, you start to increase your duration naturally, because those calls become irrelevant. Because why would a bond get called if it's getting more expensive to borrow? So if Scott Bessent lights a spark that says rates are coming down, those bonds are going to price up. That call comes back into play, and now your 10-year bond becomes a 3-year bond. So now your whole bond portfolio that by prospectus has to have a duration of 7 has kicked forward. These are called kicker bonds or cushion callables. And many bonds have that. Almost all munis are that way. Mortgages are naturally that way because you have monthly return of capital. So suddenly you see that kick forward on the duration scale. Now your whole bond fund is below prospectus. Well, what do you have to do? You have to add duration. What's the easiest way to do that is to buy long treasuries, because you get maximum duration and maximum yield right now. Well, what does that do? That naturally kicks in demand to push down the long end of the curve. And what he's doing is essentially, and it seems to be the read, is that there's been so much issuance of bonds everywhere, especially, in all these weird shadow banking, the NVIDIA $500 billion deal, the credit deal that they're doing, that it's crowding out the interest in treasuries. People are just like, there's so much to buy and so many shiny objects that they're forgetting that the shiniest object is now losing value very quickly. And so what he's doing is basically saying, redirecting. He's dropping a firecracker in the fishbowl, and everyone's going to look around and be like, oh yeah, treasuries are cheap here. And not only that, it's the easiest way to accomplish my goal. And that seems to be what he's doing. And we saw bonds rally quite a bit. They're off a little bit this morning because, the spin zone is just incredibly bad. The idea that this is QE is not only wrong, it's inversely true. It's the opposite of the truth. It's the antithesis of what's actually happening. But all day long yesterday, Scott Bessent implements summer QE, Treasury QE. He's doing this. It's not. What he's doing is he's changing the narrative, and he's doing it in a way that actually makes money. He's the anti Janet Yellen.
The way to think about this is long treasuries are probably down 30%, 30 or 40% from when they were at 3%. He's buying the treasury sold them at that level, and he's buying cheap. Like, you want to sell high and buy low. He's just doing it in reverse. They've already sold him, and now he's just going to buy him back low
with the same money he got from those sales. That's what's so hard to describe to people is like, I lend you $100 and tell you I'm going to pay interest, and then I come back and be like, hey, let me buy that $100 back for you for 90 cents, or that for $90, and you're like, great. And you make money on that deal. I've made money on that deal.
And what happens is the same thing that we saw with Intel investment, for example. Like when the Treasury goes in and buys something like this, it creates you said a spark. You could also say kind of this floor. And what it does is it gives people an excuse to go ahead and buy this, because so you can create your own reality there. And George Soros, who Besant worked for at Soros Fund Management back in the 90s, would always talk about, and say what you want about Soros, but he was a really good trader.
Like, he made a lot of money, and now you could argue he doesn't use it for benevolent reasons.
And he would always talk about the reflexive nature of markets, that you create these feedback loops.
We're in one right now.
Yes. And like I said, I mean, Besant gets that. And so he is starting this. He started a feedback loop in Intel. And I think he's going to try to do the same thing with treasuries.
I mean, the headline too is, Besant panicked. He's not panicked. I guarantee you. That guy is absolutely stone cold killer. In fact, his attempt at stone cold killer, the people are saying didn't happen, but the guy who showed up with Molotov cocktails to burn Scott Besant at his appointment hearing did get sentenced to, I think, 5 years in prison for that.
Yeah, that was
yesterday,
right?
2 days ago. So people forget that too. This all could have been much different. But I mean, he's not panicking. He's taking the opportunity as he sees it. He's making money for the country by lending people money and then buying it back for cheaper. It's crazy to think that the opposite is true.
So then, of course, you look at what's next. A couple things from me in terms of the implications. Number one is the construction market is really weak right now. Housing market is not moving fast, and now we're out of summer home buying season, so that prices might start to degrade. But I think that's the short-term impact on the kind of the knock-on impact from rates. But I think the bigger implication here is that the Treasury is taking the reins back from a period of decades where the Fed has been maximally interventionist and doing things that the Treasury has historically done. And I think that we're seeing that. I mean, this is not just me saying it. We've heard this from people who are a lot smarter than me. Say the pendulum is now swinging back to the Treasury and away from the Fed. And I think that Kevin Warsh is completely okay with that. I mean, Warsh has actually said we want to become less interventionist and let the markets do the market thing. And the Treasury is doing what it has historically done, which I think is good.
We've talked a lot about Hamiltonian Treasury. That's what Hamiltonian Treasury is. And we talked about, I mean, probably a year and a half ago, Scott Besant gave an address where he was like, here's what's wrong with the Fed. They've suffered from incredible mission creep. They're doing so many different things that have nothing to do with what the Fed does. And you could argue that Jay Powell disagreed with that because he was trying to do so many different things with the Fed. But now you have Besant who thinks that and is operating as if the Fed mission creep is not only stopped, but retracting. And you've got Kevin Warsh who's saying we've had way too much mission creep. In fact, we're going to not even tell you what mission we have. And start, so that's, he's left this vacuum, and that space is being taken up by the Treasury now. You've got arguably the most important hire that I can think of in financial markets in certainly in my career. I think that Scott Besant is the best person I've ever seen do his job. I mean, he's so impressive in so many different facets. And now you've got Kevin Warsh who's aligned with him on how this should operate. And I think that is so bullish for just America, period. I'm not even talking markets or treasuries or anything. I'm just saying economic prosperity for at least the next 2.5 years until they both get arrested if a Democrat gets elected. So that's just my opinion.
I mean, we had the Fed minutes yesterday. The biggest headline for me I mean, people are trying to read between the lines. The biggest headline for me is that Warsh wants to go to 6 meetings next year from 8.
Yeah, that was an underrated piece of the minutes. Yeah,
like that's the biggest thing is he wants less Fed.
Yeah, less is more with this.
Mm-hmm.
I mean, a lot of times this is a analogous example, but something that I think fits is that yesterday, big major news that Tamiflu, which has been prescribed for as long as I can remember, if you get the flu, they're like, oh, if you get in there early, you got to get Tamiflu. It's the best thing for someone who has flu. Well, they did a long-term study that showed that if you take Tamiflu, if you're just average sick, it makes you worse. And if you're very sick from the flu, you're 43% more likely to die. And I think that you can take a little bit of an allegorical leap there and be like, the more the Fed is doing anything and the more the Treasury is doing anything, the more likely you are to die. It's like less is more, like the body, in this case, the market, is self-healing. If you're not constantly making interventions, it will find a way to survive. I mean, that's, evolutionary theory, or even just how it works. When you apply pressure to the body, it becomes stronger. Why people do squats and bench press. The market is the same way. But if you start, doing a bunch of goofy, dumb stuff, you're not going to get any stronger. You're actually going to get weaker. And I think that, whether we're talking the Fed meeting every 5 minutes and the Fed people getting on TV and spouting off their horrible opinions every day on TV is better than 6 meetings a year where they say nothing, I think you're wrong, in the same way that apparently taking Tamiflu doesn't make you better if you have the flu. It actually makes you worse. So there you go. That's a very roundabout way of explaining anything, but welcome to the show.
I think this was a great show for anyone who wonders what we're about and what we want to do, and what we're trying to do here. Yeah, I mean, if you want to share this one, I think this is a good one. But we will see you tomorrow. Have a great day. Bye.